Welcome.
Tash,
How you been?
I'm doing really well.
Yeah?
Wearing my best Snoopy shirt.
Yes.
Living the dream.
I was wondering if that was your pyjama top.
No,
Okay. Does it come with pyjama bottoms?
it can.
Sorry. All right. Let's talk about profit and business.
Yes.
Yeah? All right. Look, there's a myth that when you hit seven figures, you've made it. So how come we have so many people who own businesses that run seven figures, but they're still, stressed, their cash is strapped, they're reaching, they're not happy, they don't know where they're going, and it's not easy street. Why not? It looks like it should be. I'm sure if I had seven figures coming in every year steadily, it'd be easy.
Yeah, that's what everyone thinks.
Yeah.
And so, as human beings, we tend to put these ideas on a pedestal, right?
Yeah.
That we think that there are certain numbers that have a significance where everything changes. And the interesting thing that I've observed is most business owners blaze past seven figures without even giving it a second thought, right? Like they pursue it and they achieve it.
Wait, how much is seven figures?
$1 million.
They breeze past $1 million without realising.
Yeah. Most of them just don't stop to smell the roses, right?
I guess, yeah, if you've got 893 and then next day you've got 1.2, you may not notice.
Exactly.
Okay.
And so the issue with that is that they're focused on a vanity metric.
Yes.
Because revenue doesn't pay the bills.
No, but it looks
Right?
good.
Like, and that's the ego thing.
Yeah.
Right? Like, you never go into a restaurant and pay with revenue,
No.
right? You pay with cash.
Yeah.
So
I thought you paid with expenses.
you got to cash to be able to pay in order for it to turn into an expense.
Sorry.
So the other issue that we see is that most business owners are expert technicians.
Right.
So they take a lot of pride in what they do. They've learned a trade. They've mastered a skill. They know how to trade time for money. But what they have not mastered is how to manage that money and make it work for them.
So they're not really business operators.
Correct.
They are technicians who own a business that they then work in.
Correct.
Okay. Yep.
And so what ultimately happens at seven figures or somewhere in that vicinity, and it's usually between about $1 and $3 million, is that the complexity astronomically increases. Why? Because we've now got more people that are required in the value chain. You've got more technicians on the tools. You've got more clinicians that are seeing patients. You've got more consultants that are seeing clients.
So more at the cold face.
There's more people on the coalface. And inevitably what happens is that there needs to be layers of management, layers of oversight, and we ultimately need to throw money at solving these problems. Now, the root cause of the issue is a lack of systems.
Yes.
Because
Okay.
what we often see is that expert technicians transition into being managers. And they try and oversee the technicians. And what they end up doing is micromanaging the technicians.
Right.
They go, I'm a unicorn, like I'm phenomenal, I'm a 10 out of 10, right? And these people are numpties. Like,
Which way? Both ways?
yeah, well, I think there is probably both ways. But these business owners are looking at their team members and saying, these people are idiots. Like, no one could do it as good as me. Why can't
In
these...
the technician area
Exactly.
or in the... Right, okay.
In the technician area. And this leads to micromanagement.
Right.
Tash, why haven't you done this? Why
Do it
didn't
my
you do
way.
that? Have you checked this? Have you checked that? And what that does is it creates tentative relationships in the business. These people feel like they're walking on eggshells.
Yeah.
And this cycle continues to rinse and repeat. So how do we fix it? We firstly need to realize that managers should not oversee technicians. Managers should oversee systems. And it is systems that oversee the technicians.
Give me an example.
So in a business, there are 4 core systems. Marketing. How do we generate leads and opportunities?
But what about the one for the technician?
We'll get to that.
Okay.
Then sales. How do we turn those leads into paying clients and customers?
Yeah.
Delivery. How do we deliver on our promise to those customers to turn them into raving fans? And growth. How do we do all of those things profitably so we have surplus cash to either pay out to the shareholders or to reinvest back into scaling the business, or both?
Or spend.
Yeah, exactly. So the point of this is that we need to build those 4 systems first. And the issue is for most business owners is that everything's up in their head, right? So they're trying to frantically get out off the tools. They're throwing people at their problems. And what we often see is that there's blowouts in their cost of sales. So what they think it costs them to do a job and what it actually costs are two fundamentally different things. And we see blowouts in terms of wages and salaries.
So when you say they throw people at it, but they're not throwing their own IP, is that right?
They're hiring people out of desperation, thinking that they're going to be the saving grace of their business. Because in some way, shape or form in their head, they go, if only I can hire somebody like me, all my problems will be solved. And the issue is that...
All right, I've thought that.
Yeah, and the issue is that unicorns are very, very rare, right? And the whole idea of growing and scaling a profitable business is building a world-class system that you can plug average people into and produce above average results.
Yep.
That is the key.
So most people, though, will think, no, the key is the quality of my product.
Quality needs to be systematic, right? I'll give you an example. I was speaking to a fellow recently who runs a high-level strategic tax advisory business. He's worked for the big four accounting firms, doing really high-end consulting level work. And obviously got to a level of expertise that he's like, why am I doing it for these monkeys? I may as well go and do it for myself. So he's gone out into his own practice. The practice is doing pretty well, $2 million a year, but the business revolves around him. The clientele that seeks him out are people who are looking for his expertise.
Yes.
Which means that he's not a business owner, he's self-employed.
Yes.
He's trading time for money.
Yeah.
So he owns a job, right? He went from having a job to now owning a job.
Yes.
Now,
he has an unsupported job.
correct. So, and the issue with that is that he's now a prisoner of that job, right? Much like he was in employment, he's probably more answerable to the responsibilities of running his own business than he did when he was an employee.
Well, he has more responsibilities.
Correct.
Yeah.
So the only way we get out of that, if we want to go from being self-employed to being a business owner, is we need to build a system. And that system comes down to productizing our value proposition. If everything that you do is unique and bespoke, it's not scalable.
Yes.
And like we refer to that, like it's okay. There has to be a place in the market for somebody to do that
like
work,
it. Yes,
right?
absolutely.
You might be a high-end barrister, you might be a high-end tax advisor, whatever it might be. And I refer to that as the Mr. or Mr. X model.
Yeah.
Right? You've got the X factor, and you need to sell it for an astronomical premium in order for you to gain any kind of leverage.
Yeah.
Right?
That's the celebrities and the...
Correct.
Yeah.
And so the key to that model is that you need to control the premium pricing, and you need to ensure that people understand the sheer lack of supply that you have available. And for that reason, the demand increases for the amount of supply available, and you can name your price.
Yeah.
That's not what most business owners want to do. Most of the business owners I work with want to be anonymous. They would prefer that nobody knew who they were. They would prefer to be able to walk down the street without being recognized. They would prefer to be independently wealthy and be able to have a business that can operate
Without them
completely. So what do we need? We must productize our value proposition. We need to get really clear on who we are serving. So that comes part of that marketing playbook. And we need to get clear on how we serve them, which is the delivery playbook. And it's what is our value flywheel? How do people come in, and what are the key problems that our ideal market are trying to solve and the goals they're trying to achieve? What's our proven process of the exact steps that we take every single time in order to solve those problems and achieve those goals? And then what is the outcome that the client has as a result? And then what can we charge? What's the maximum amount that we can charge where the value is significantly ahead of the price that we're charging?
Yeah.
And it becomes an absolute no-brainer.
Yeah.
And then it's just a matter of how do we continue to develop the system?
So if you were to look at somebody's $2 million business,
Yes.
say, what are the first numbers that you actually look at? And what do most owners get wrong about the difference between profit and cash?
The first number that I look at is what is their operating profit margin. And interestingly, for most businesses that come to me, they're making about 10 to 15% profit margins. In some cases, they're making no margin, right? And they're like, okay, well, I've got a $2 million business and 10% margin is 200 grand. Like, they're like, I could go and get a job and make 200 grand and get
And
my
not have all
weekends
this
back.
worry.
Exactly.
Yeah.
So they're like, if I'm not making 500 grand a year or more, it doesn't make sense.
Yeah.
So how do we achieve that? Well, you've got to, if you in that same scenario, to get to 500 grand, you've got to build a $5 million business at 10%, or we've got to work out a way to double the margin, right? Or a combination, right? So that's the first thing I look at. The second thing I look at is revenue per head.
Per head of client or per head of
Per head of employee. So,
employee?
Yes. And so what that tells us is what revenue you're producing per person in your business.
Yes.
And what that allows us to do is if we track that over time, our goal is for, of course, that number to be as high as possible.
Yes.
Right? And when we track it, we want to work out how do we be more efficient? Because once again, it's that problem that most business owners dilute their profit because they are overhiring. They have too many people in their business, and as a result, that consumes their profit.
Because that appears to be the solution. I don't want to deal with this problem. I'll get somebody else who will do it for me.
Correct.
And they will increase the business enough that it's worth it, but it doesn't work that way.
Exactly. And we can create accountability around that. Like, for example, for a typical service business, we want to keep wages to revenue at 30% or less. Now, for some industries, that's really hard. But what we do with that is we say, okay, we want revenue to wages to revenue to be 30%. If it's ever below that, that becomes a bonus pool that we then provide to the team members. Because what often happens is that...
All right, if it drops below 30%.
Exactly.
Sorry, you dropped me. Yeah.
So let's assume this puts some numbers around it. It's $1 million business. We have a budget for $300,000 in wages.
Yep.
Cool. If we can keep that same wage pool and grow the business to 1.5 million, then we've got an extra $150,000 in wages. Now, what usually happens in a service business is that the team goes, we're under the pump. We need you to hire somebody.
Yeah.
And you go, okay. But you say, okay, well, look, we can go and hire that. This is our budget. There's $150,000 in this bonus pool. I can go and hire another person, or you guys can pick up the slack and you can split it among yourselves as a bonus. What would
Or
you
half
prefer?
half.
Or half,
Yeah,
right?
yeah.
So what we're able to do is create accountability in the team where they start thinking, at least in some way, like an owner.
Yeah. It's also, yes, it's accountability, but that sounds to me also like ownership and agency.
Correct.
They gain agency over their own lives.
Correct.
Because it's easy to sit and whinge and say, we're under the pump too much.
Sure.
And that, but the fact from the owner's perspective is they are managing it.
Correct.
So are they under the pump?
Exactly right.
Yeah.
And so the unfortunate reality that most business owners don't think about is that employees haven't been taught the economics of business.
No, and in fact, they often told you you're not to know.
Exactly.
I've been in businesses where they've said to me, you're not allowed to discuss your salary with the next person's.
Yeah. It's wild.
It is wild. Or we say, can we see, what they allocate? No,
Yeah.
none of your business.
Yeah. Well, I was speaking to a guy today. We're interviewing for filling a role for in our accounting business. He's an accountant, and I asked him, how much are you billing in your current role? And he goes, oh, they don't share any of the finances with us. This guy's an accountant. And so I'm like, how do you feel being an accountant, giving tax and accounting advice to your clients, but you don't even have transparency to measure yourself? And he goes, I'm flying blind. So,
But half the time they don't even realise they're flying blind.
No, exactly.
It's not expected in their...
It's not.
Yeah.
And the unfortunate reality of this is that because you don't share the numbers, the employees make assumptions. Yes. And they always think that you're money bags, and they will always assume that you're doing better than what you are.
And it looks like it.
Correct.
You're the CEO, you're dressed like, well...
Maybe not dressed like it, but...
You go on the holiday, or you drive the car, or you whatever, you have the farm, or whatever you do.
Yeah.
And they think he's spoiling himself.
Yes.
They don't know what it takes, and yeah.
Exactly right. So it's important, and it doesn't need to be all of the numbers, but you want to give some level of how do they measure performance? Like, what is the benchmark for performance? Are they meeting and exceeding, or are they falling short of that performance? And we found that like what gets tracked gets measured, and what gets measured gets improved. And the right people, high performing people, want to be measured.
Yes,
and they want to improve.
absolutely. Absolutely. All right. So could you walk us step by step how an owner sets up their money so that profit is guaranteed first,
Yes.
not whatever's left at the end of the month?
Yeah. So we've spoken about this a lot in my books and in the podcast, is that we need to set up a bank balance accounting system.
Ah, yes.
One of the biggest challenges that I see for business owners is that their profit and loss statement doesn't match cash at the bank. And this comes from a few issues. First and foremost, business owners don't understand the difference between their profit and loss, their balance sheet, and their cash flow statement. So what we need to understand is that the profit and loss is a movie. It has a start, has an end. It starts on the 1st of July, finishes on the 30th of June. But much like a movie, it's a theory, right? It's a fable. And so we need to acknowledge it as such. Then we get into the balance sheet. The balance sheet is a picture. It's a snapshot. A snapshot in time at a particular date of what the business owns and what it owes.
Yeah.
And
Like a stock take.
Exactly. And what we need to understand is firstly the cash, because the cash never lies.
Yeah.
There's either money in the bank or there's not.
Yeah.
So we want to work out, okay, over a particular period, has our cash increased or decreased? Next is our current assets. So our current assets are our assets that we are going to turn into cash, likely within the next 12 months. So for most businesses, it's accounts receivable that's the issue.
Yeah.
They've raised the invoice, so it sits on their revenue and their profit and loss, but it hasn't been paid yet.
No, hasn't shown up in the bank.
Exactly. Next is inventory or work in progress. So if you run a product-based business, your inventory on the shelf is dead money until you sell it, right? And work in progress, if you're doing project-based work that you've got to get projects to a particular point to be able to invoice, how long it takes you to get it to that point is a really important thing for you to measure. So those are the key things we need to be mindful in current assets. And then we need to look at our current liabilities. And our current liabilities are liabilities that we need to pay within the next 12 months. So that's our suppliers, it's our GST, it's our PAYG, it's our superannuation, it's our corporate tax, our integrated client account. It's the money that we have to pay in the next 12 months.
It doesn't include your marketing and your...
No, that should all be on the P&L.
Okay.
So it's important to understand that because that is what determines your cash flow. It's like your current assets in cash and your current liabilities is ultimately what's going to impact your cash flow in the short term.
Yeah.
And most business owners, first, they've never been educated around their balance sheet, but secondly, they've never looked at the balance sheet.
Really?
Flying completely blind. So you can understand the financial statements. The underlying prerequisite, though, is that you've got good bookkeeping.
Yes.
Because if your bookkeeping is done wrong, those financial statements are wrong. So back to my previous point, the bank balance never lies.
Yes.
There's either money in the bank or there's not. And most business owners have all of that money coming into a single bank account. So all the money comes in, all the money goes out, and then they have no transparency. So we need to segment it. So the first thing we need to segment is where I see a lot of businesses getting into trouble is their tax money. So GST, PAYG, super, corporate tax. We work out, like tax is a consequence of making money. So we need to work out in your financial model, how much do you need to be setting aside to cover those taxes? Second is cost of sales. So your subbies and your materials. Set that money aside because it's not your money. So we've got to make sure that money's there ready to go. Then operating expenses, your fixed expenses, your salaried employees, your rent, all of those kinds of things.
Yep.
Then we've got owner's pay, making sure that we pay you because you're the number one employee. And then we've got profit.
Yep.
Because you deserve to get 2 paychecks.
Yep.
So the philosophy that we uses a principle called Parkinson's law. And Parkinson's law basically means that as a human, we use the resources we have available. So the more resources we have, the more we use. And when you run a multi-million-dollar business, that's a lot of resource.
Yes.
So it tends to slip through our fingers. So the purpose of this structure is to presuppose profit
Yes.
and make the business survive on everything that's left, as opposed to spending willy-nilly and then hoping that there's going to be profit left at the end.
So did we put a percentage on that profit?
Yes. So we have a series of benchmark percentages that we set for businesses from basically startup all the way through to 50 million. But as a general rule of thumb, we want profit to be 20%.
Okay. So if we're 2 business owners, same business,
Yes.
in different parallel universes, both of them, however, have a Jackson. One business is profitable, The other one's running on fumes and it doesn't know it. What are the numbers that are going to tell them apart?
Yeah. We've got to realise that your financial position is a lag indicator. So we need to reverse engineer that backwards to understand the lead activities, actions, decisions that had to have been made to get to that financial result. Because honestly, the only difference between a profitable business and an unprofitable business is a shrewd decision maker.
Yes. Yeah.
Right? The person who made profit was just disciplined in their approach. They were disciplined when they created their financial model in the first place.
And they had a good one.
They had a good one. And sometimes they stumble across that, right? And they were disciplined in hitting their lead numbers that resulted in the lag outcome that they wanted.
Yeah.
So for all businesses, we want to reverse engineer it. So we think about profit. Well, in order to make a profit, there's expenses, operating expenses. There's cost of sales, and then there's revenue. To then make revenue, there's a client. To get that client, there was a price that you had to quote on that particular client. Then to get that client, there had to be a lead.
Yep.
And you likely had to take that lead through a sales process. So you had to do an on-site consult, you had to send them a proposal, you had to get the proposal accepted. And then the lead had to make an inquiry in the first place. And there might have had to be marketing activity you had to do to get the lead.
To generate the lead,
So we've now got all of these stages, from lead to first inquiry to on-site to proposal to accepted to money in the bank to do the work, incur the cost of sales, operating expenses to profit.
Yeah.
So what we can now do is set a target for all of those things.
Yeah.
And work out where are the leaky holes in the bucket.
Question just on the way. That ladder,
Yes.
is that what we're talking about when we talk about industry benchmarking?
Industry benchmarking is a little bit different.
Can
I'll
those
explain.
things be benchmarked?
They certainly can. The reason why I personally don't like doing benchmarking when I set these is because each business is at a different stage. And my concern is that some businesses compare their chapter 2 to somebody else's chapter 10, right? Comparison is the thief of joy.
Yeah.
And businesses are a unique beast in themselves, right? There's so many variables that it does make it hard to compare. Now, when I do think about benchmarking, I use the profit as a benchmarking, right? I'm like, okay, in an industry like yours, your gross profit should be this. Your operating profit should be this. Your wages should be this.
Yeah.
But it's about, well, how far can we push your business?
Yeah. But to me, benchmarking would tell you you're doing this upside down to everyone else and it works, or you're doing this upside down and it's not working.
Definitely.
So
yeah, and
that's
look,
why
some of those
asking,
benchmarks might be, well, okay, you should be closing on, when you send a proposal, at least 40% of your clients should be saying yes.
Yes.
On your gross profit, it should be at least 60%.
Yeah.
And your net profit or your operating profit should be at least 20%. So those are the kind of benchmarks. And then we'll work out, more importantly, it's about saying, okay, Tash, what are you trying to achieve? So, okay, your profit target's 500,000. Okay, this is what we need in revenue. This is what we need in clients. This is what we need in leads. And then we track against that. And the interesting thing about this is sometimes it's a guess.
Yeah.
All right? Because it's like, I'm going to come up with a hypothesis.
Yeah.
We're going to then track the actuals against it. And then we're going to go back and compare over a quarter and say, okay, what was close? What wasn't? And what information can we extract to improve this process next quarter?
Look, I would say every prediction is a guess.
Sure.
Because we don't know what's going to hit.
100%.
And even if you've got 10 years track record, yes, it's very likely the next year will be predictable, but it's still a guess. Isn't
I
it?
agree. And the most important thing of all of this is the tracking and measuring and this feedback loop.
Yeah.
So I'll give you an example. We had a client that come on board with us that runs a joinery business. He bought this business and he thought it needed a turnaround. It was on the verge of failure. And he thought that he can come in and turn it around. And this business was just a cash-eating monster, losing money hand over fist. And he went through what's called a small business restructure.
Yep.
Which is essentially a simplified liquidation, right? Clear the debts, basically recapitalise the business, have another crack at it. And he was basically on the verge of failing again. So we had a conversation, said, like, you are literally 6 weeks away from going broke and losing everything. So what do? We set up a scorecard. And a joinery business is a conveyor belt, right? Of getting plans, going into design, then going into production, then going into install, then getting paid.
Yeah.
So we created this scorecard tracking week on week from the very top of the funnel all the way through down to cash hitting the bank account. And we've been running it for about, I think, 14 or 15 weeks now. And we've seen a fundamental turnaround in the business. Why? Each week we looked at the numbers. We got the business owner to say, okay, where's the bottleneck? What's the one constraint that you need to obsess over this week? Oh, things are getting stuck in pre-production. Cool. I'm going to focus on fixing that. Beautiful. Next week, how did you go? I fixed that. All right, what's the next issue? And it's applying this theory of constraints. The business grows at the capacity of its most significant constraint.
Yeah.
If you solve that constraint, then it must grow.
Yep. And then you can find the next one and the next
Exactly.
one. Yeah.
So this guy's still got a long way to go, but it just goes to show that in a very short
he's still
period
there
of time,
after 6 weeks.
he's still there. He's still hanging in there. And the pushback that I get is that people are afraid of the come to Jesus moment of the clarity and transparency that this kind of exercise represents. A lot of people would just prefer to stay in ignorant bliss of not knowing.
Do you think this is because they identify too closely with the business?
They don't want to quantify the extent of their failure.
Yeah.
And so for that reason, they would prefer to just stay in this la-la land as if it doesn't exist. And that's, but once again, it comes down, people have got to be ready.
I've lived there. I understand.
Yeah.
Yeah. All right. So what was the number one thing that told those two businesses apart?
It's being shrewd, like knowing
The
your
decisions.
numbers. It's informed and educated decisions.
Yeah.
It's not willy-nilly guesstimates, right?
Not on the fly.
Correct.
No. Okay. And so anyone who starts a business has in their mind that they're going to get paid by this business. They're going to get paid for doing the work, and then they're going to get paid for being amazing enough to build this business for everyone, right? How should they actually pay themselves, and how do you decide what stays in the business versus what you pull out to build your wealth so that you're, resilient?
Business is risky. It's very risky. And for that reason, you must take money out of the business.
Yeah.
Because there are no guarantees that your business is going to survive. There's no guarantees that your business is going to have a value that can be sold. So you owe it to yourself and your family to pay yourself fairly and build wealth outside. So what does that look like? It's different for everyone. It comes down to your cost of living.
Yeah.
So you need to get clear on what are your fixed expenses as in a household. So the mortgage, putting food on the table, paying the bills, that kind of stuff. Then your discretionary, week to week. So going out, having a nice dinner, buying something for yourself, birthdays, holidays, that kind of thing.
Okay.
Then we've got, maybe. Then we've got your holidays. What do you want to spend per year in terms of travel and going overseas? And then there might be other discretionary stuff like helping family and that kind of thing. So we add all those things together. Look, for most of our clients, that number is probably starting at about 200 grand, goes up to 500 grand. So then we need to make sure we've got surplus. And as a general rule of thumb, you want to have 20% surplus above and beyond whatever your lifestyle costs. So
surplus of revenue?
Surplus cash in terms of what you've paid yourself after you've covered all those expenses.
Oh, for the individual. Okay,
how much personal surplus do you have? Because it's only surplus that we can build wealth.
Okay, yeah. All right. So I was thinking of the salary and the wealth building money as separate, but they're not.
Not necessarily.
Okay. All right.
The reason for it is because what I often see is that business owners get themselves into a lot of trouble because their accountants have said, Tash, take the least amount of money out of the business because it's good for tax. And so they draw 30 grand or 50 grand or 80 grand. It's never enough. So what do? They take ad hoc drawings out of the business.
Which don't come under those smart decisions made with discipline, looking at the whole picture.
And I'll explain to you the issue. So when you're on a salary, you pay your tax as you go, right? You pay your super. It appears on the P&L. So it doesn't take away from, it doesn't convolute profit.
Yes.
Your ad hoc drawings don't sit on the P&L because they're a director's loan. They sit on the balance sheet and they're hidden until the end of financial year. They accumulate. And then at the end of the financial year, your accountant will come to you and say, hey, Tash, you've got this director's loan of 200 grand of extra money that you've taken out of the business. Can you pay it back? No, I've spent it. Okay. Well, we can declare it as a dividend, assuming there's profit, I've got to pay top-up tax. So potentially 17% extra top-up tax, maybe 21% extra top-up tax. And you're like, oh, what's behind door number 3? And then the accountant says, oh, we can put on this Division 7A loan. And you're like, that sounds good. Do I have to pay any tax? No. But the
today.
issue, not today. The issue is that a Division 7A loan requires you to pay interest to the company of 8.6% under the current rules. You have to pay it back principal and interest over 7 years. And the principal component that you pay back each year has to be distributed in that year as a dividend, which means it creates a tax issue. And in 1 year, it's not the end of the world, but I see business owners doing it year after year after year after year. And they come to me and they go, Jackson, I've got this tremendous tax problem. How do I fix it? You can't.
Well, you just pay it.
It's too late. You just got to pay the tax.
Yeah.
So what they end up doing is, because of the fact that they haven't taken a good salary at the beginning, what they need to live their life, you can take out directors' loans, but for the purposes of declaring a dividend at the end of the financial year and having the money set aside to pay the tax, you've done yourself the biggest disservice.
Yeah.
I'll give you an example. We had a client who come to us recently that runs a national business, does about $15 million a year in revenue. They owe $2.2 million in unpaid taxes to the ATO.
Which the ATO would like.
The repayments on that is $30,000 a week.
Much more useful into the business, wouldn't it?
Well, and imagine $30,000 a week building wealth. Like, what could you have done with that money? And once again, it comes back to this Parkinson's law. If you had the structure,
Yeah.
if you had accountability to the numbers, if you were paying that tax as you went, you probably wouldn't have even felt it.
Yeah.
That $2.2 million has just disintegrated into other little meaningless things that if I asked them, they probably couldn't even tell me where it went.
Yeah.
It is just...
Shrapnel.
Exactly.
Yeah.
And so this is the opportunity cost that exists for business owners. The thing that differentiates my wealthiest clients from those who struggle the most is that they set up these systems that protect themselves from themselves financially.
Yeah. All right. When you get handed a 7-figure owner's numbers, what's the first thing that makes you wince?
Oh, fuck.
The leaks that they don't see coming.
Oh, my gosh.
Okay, maybe I should ask, what makes you cry?
I haven't cried over somebody's numbers yet, but I do definitely wince. And the issues are always the same. The two biggest issues that I see is chart of accounts being incorrect. Case in point, had a client yesterday who runs a food services business, a multi-8-figure business, and all of their revenue is in a single line item of sales. And I go, do you have more than one client? Yeah, I do. Do you serve multiple industries? Yeah, I do. Wouldn't it be nice for us to be able to see the trends of those various industries and clients? And she goes, yeah, that would be nice. Why has your bookkeeper or accountant never spoken to you about this? I've asked, but they've never done it. That's issue number one, chart of accounts. Because the way I look at it is when you look at your chart of accounts, which is the categories that all of the items are reconciled against, I look at it from the perspective, if I'm a complete stranger and I pick up these financials, do I have to ask any questions to understand the numbers?
Yes.
Or does the chart of accounts tell me the full story?
Yeah.
So I want to see breakdown of revenue lines, I want to see breakdown of cost of sales, and I want all of the operating expenses to be itemized. So clear.
Yeah.
So no general expenses, no sundry, not everything grouped into a single wages and salaries, like break it down into roles or divisions. So that's the first thing. The second issue is using the balance sheet as sweeping the rubbish under the bed. So I would probably say 90% of balance sheets that I see for businesses, even going up to $30 million a year in revenue, are wrong.
Right, teach me.
So one is not having the bank account balances segmented. So that's an issue because you can't see what money you've got set aside for what particular purpose.
Okay, so if you've got one in account and one out account.
No transparency.
Yeah.
Second thing is that there's significant accounts receivable and there's no policy in place for one single person accountable for chasing it.
Yeah.
Next is that if they do have work in progress or inventory, they're not updating that in their accounting software.
Okay.
And so that means you don't know whether you've got enough inventory or if you've got enough work in the pipeline to be able to keep yourself afloat, that's an issue.
Or what your future work is going to cost you to
Correct.
deliver.
Next thing is a fixed asset register of all of their vehicles,
Yep.
plant and equipment, computers, all of those kinds of things, because there's depreciation. There's all of these tax deductions that you could be making, and how are we supposed to know what the cost base is? How are we supposed to know which method of accounting to use in terms of depreciation? And the next is the current liabilities.
Is depreciation worth doing?
Well, like we never want to make, it certainly is on the basis that you needed the thing in the first place,
Yeah.
and that there's depreciation to be claimed, right? Another example, we had a client recently who runs a mechanic workshop, and he goes, Jackson, I've got 4 forklifts. I go, why the fuck do you need 4 forklifts? He goes, I don't, I only need 1. I go, why do you have 4? He goes, oh, for tax. And I'm like, man, okay, let me paint a picture for you. You have $1. You can spend that $1, the government gives you back 25 cents, and you're still 75 cents out of pocket, option 1. Or option 2, you have $1, the government takes 25 cents, but you still got 75 cents. Do you want to be out of pocket 75 cents, or do you want to be ahead 75 cents? I'll be ahead, please.
But
So
they
stop
don't.
buying forklifts.
Yeah.
You know? So that's and
But it's such a known thing to do.
It is.
In small business anyway. I don't know about, I think big business
big
is
businesses,
smarter than that.
they tend to be.
But,
And-
you know, in small business, I mean, and it's so encouraged because end of financial year is a commercial bonanza for
sure.
big business.
And the analogy I use is when you're a hammer, everything looks like a nail.
Yeah.
And so accountants measure themselves by how much tax they save, not by what is in the best interest of their clients. So that's the issue. So the next issue is the current liabilities. So like at a very bare minimum, make sure that your active outstanding GST, your integrated client account, your PAYG, your super, long service leave, have all of these things there and be updated monthly. Because what we need to be able to know is that at a glance, do you have the liquidity to cover all of your short-term liabilities or not?
Yeah.
Like these are the issues that I see all of the time. And it's just laziness. It's laziness on behalf
It's
of the
just lack of
accountant.
differentiation. It's like, I've got money,
Well,
but you might not.
the thing is, and look, the clients aren't to know. It's the financial professional's responsibility. And the issue is just laziness.
Yes, but if you're the owner
Yes.
and you don't know and you haven't got someone who does know, then I think it's more than lazy.
Sure.
I think it's disastrous.
I agree. And a lot of people have got themselves into some horrible situations because of that. And unfortunately, the business owners don't know any better. So,
You're very generous.
yeah.
Yeah. Okay. All right. So what are the first 3 things that an owner should hand off so that the business stops needing them in every decision? And which order do we do it in?
Yeah.
Oh, God, I wish I was at that point.
One of the biggest bottlenecks that I see for business owners is split bandwidth. And it is so easily fixed by hiring an executive assistant. Like, it's interesting for so many of our clients, like they can't finish a task without their phone ringing or a notification ping or like something drawing their attention. And the issue is this context switching, right? It's like they're in flow and then the phone rings and then they have a conversation and they go, fuck, what was I doing again? And it takes them like 10, 15 minutes to get back in the swing of things. Before you know it, like the day's gone, right?
And you don't actually know what you've lost.
Exactly.
When you fall out of flow, there might have been a diamond coming.
Correct.
Yeah.
So the first thing that all business owners who are doing 7 or 8 figures needs to do is hire an executive assistant.
Yep.
Hire them in the Philippines, pay about $3,000 a month, get a high level person who is a thought partner,
Yes.
not a task partner, somebody who's going to come ask you for instructions, what do I do next, that has the ability to see what's coming, be fiercely defensive of your time, and to take a lot of that communication off your plate.
Like a co-steward.
Yeah, like their job is to be the gatekeeper.
Yeah.
Right? They're there to ensure that everybody has to go through them in order to get to you. And that allows you to then get into deep work.
Yeah.
So that's the first thing. At $3,000 a month, like even if you get 20 hours a week extra, it's an absolute no-brainer.
Yeah.
The second thing is building a delivery team, because as a business owner, I believe that it is far, if you think about those 4 playbooks, marketing, sales, delivery, growth, try and find somebody to market your business. Really fucking hard. Try and find somebody to sell for you. Really fucking hard. Try and find somebody to drive profit in your business. Very fucking hard. So it's all hard, but it's like, pick your hard. It is the easiest to find decent people to do the work.
It's also the engine, isn't it?
Correct. Exactly.
I mean, that's what makes the money.
Correct.
Yeah?
So it's like build a system and then hire people that you can plug into that system to buy back bandwidth. So then you can focus on marketing, sales. And then usually after that, then we build the sales department, then we build the operations and growth department, and then lastly, we build the marketing department.
Yeah.
The reason for it is because I find that it's the most important thing, and so it should be the last thing that we hand off.
Isn't it also that you want to know that your delivery is resilient and can expand before you turn the tap on harder?
Exactly.
Yeah.
And what I also find is that that gives you the observations of what's happening in delivery that you can then use in marketing and sales to attract better people, to speak their language, to speak to their pain points, those kind of things.
All right. That sounds good. Tell us about an owner that you have worked with who turned a busy, low-margin business into a genuinely profitable one. What actually changed?
Yeah. We see this all of the time, right? Because most of the people who come to us who are doing 7 and 8 figures just aren't making the kind of money that they thought they would. So we had a client who come to us who had a psychology business. And like, you might think, like, psychologists are so highly sought after. There's not enough psychologists. There's a mental health epidemic. So you think that there must be swimming in it, but it's a really hard business. The psychology business is a really hard business. And it's because the clinicians usually don't want to work full time and they want to work as contractors in the business. So having an employed workforce versus a contract workforce is very, very different.
Yeah.
Like, how do you manage the culture? It's not hard to get patients.
No.
There's usually waiting lists. There's a significant kind of power vacuum that exists. So this client came in, they're running a couple of practices, doing multi-million dollars a year, making no margin. So first thing we did is we implemented what we call the Aureus operating system. Because even though these people are contractors, they're still making a decision to work under your brand.
Yeah.
So it's like, how do we create a vision that is compelling enough that their vision can live inside it? So it allowed us to get everybody rowing in the same direction. Next thing we did is we created a strategy. And the strategy was, what are we going to achieve over the next 12 months to keep us on track for this 3-year vision? So what that allowed to do is to get buy-in and to create clarity around what the numbers and inputs needed to be. And what that also resulted in is there were some people who just tapped out. They're just like, yeah, this isn't for me. Perfect. Right. Let's replace you with people who are a fit.
Because there are also a lot of people to
Of
hire.
course.
Yeah.
So then we started implementing a scorecard, which was, okay, what are the numbers and the metrics that you need to hit in order to validate your spot, to measure your success and to ensure that we're working towards our 12-year plan? So
For the contractor.
Correct. And for all the people in the business, there was also an admin team and whatnot. So we chunked 3 years into 1 year, 1 year into 90-day sprints, and that's tracked on a weekly basis. And what that allowed us to then do is support that with feedback loops that we call a momentum meeting, where the owners of the business would meet with each person in the business once a month, review the scorecard, talk about their performance, what are they doing well, what are they not doing so well, and tweaking, fine-tuning. And as a result of this, over the course of the last 12 months, they've had the most profit that they've ever had in business.
Excellent.
And it's not that we did anything miraculous. It is just that when you follow the proven process, it works.
Yeah. And you connected all the dots. You didn't connect 90% of the dots and then just leave it.
Exactly.
Yeah. That sounds absolutely wonderful. Okay. So if someone only remembers one line from this episode, what would you want them to remember?
You must make a decision to be shrewd in business.
You must make a decision to be shrewd in business.
And that doesn't mean being a dick. But it also doesn't mean being a pushover. You will never achieve more than average doing less than average, right? You must be prepared to do more. And you can't just coast. You can't just expect that your numbers are going to work themselves out. You need to take personal responsibility. And there's skills you've got to learn. So you've got to be shrewd.
All right, give us that one line again.
You need to choose to be shrewd in business.
Choose to be shrewd. Beautiful. Thank you.
Pleasure.